So a business transaction, measurable in terms of money, satisfying, that is technically called the money measurement concept, has two legs. So the skill of an accountant lies in identifying these two legs. We have taken a few examples in our last session. Purchases, sales, wages, assets. So ultimately it is a business transaction which is satisfying money measurements, only those which are measurable in terms of money, which can be split into two legs, leg 1 and leg 2, let us say. One of which has to be technically debited and the other is credited. Either to be debited such that the other or the others are credited. This is technically called the double entry system. Every transaction has two legs, one of which is debited and the other or the others are credited. So essentially, bookkeeping or accountancy is based on the double entry principle. So it is in two steps. Identify the two legs of a transaction, debit one and credit the other. So every transaction that a business enters into during the accounting cycle or the accounting period requires this kind of a treatment. Taking a few examples again to identify them. If we take a few examples exactly as we done the last time. Normal transactions that a business enters into. Purchase. If it is a purchase of goods, you have a purchases account and a cash account. You purchase raw material and pay for it. If it is sales, you have a sales account and a cash account. Or if it is wages which are paid, payment of wages, salaries to employees, workmen, workers, you have a wages account or a salaries account and a cash account. If you have purchased or acquired assets like furniture, plant, machinery, buildings, computer, car. So these are assets which are used in connection with the business, not meant for sale or resale in the ordinary course of business. They facilitate the carrying out of the business or the profession, trade, vocation, whatever. So when assets are acquired, you have an asset account, the respective asset account, furniture account, building account, land account. So the respective asset account and the purchase is paid for in cash. So I have taken examples where you have one of the accounts as purchases, sales, wages, investments, assets, and the other being cash because cash is paid for it. It could be even the bank account, which is the other leg of the transaction. If you are making a payment by, let us say, an NEFT transaction, an RTGS transaction, or a check is paid, any electronic method of payment. So we have now been introduced to 1, 2, 3, 4, 5, 6, 7 types of accounts. Purchases account, one leg of a purchase transaction. Sales account, one leg of a sale transaction. wages account, one leg of the wages paid transaction, and so on. So every transaction can be split into two legs. So what we see so far is the concept of a business transaction, the net effect of all the transactions during an accounting period resulting in a profit or a loss. The two legs of a transaction to be identified, of which one is to be debited and the other is to be credited in the double entry bookkeeping system. So double entry is nothing but the double effect of a transaction, one being a debit and the other being a credit. Now, you need to understand the distinction between a cash and a credit transaction next. Let us take the example of a purchase of goods or stock in trade or inventory, consumables, anything which is to be transformed into its output for sale. So a purchase transaction where you are purchasing raw materials which is used as input. There are three ways of arranging a purchase. I can pay for this in cash, cash payable. I can pay for this through a banking instrument routed through the bank, a check, electronic payment, where the bank is used as a platform for making the payment to the supplier. So it is either cash or bank with which the transaction is settled once and for all. I have purchased the raw material, purchases account is identified, and the other leg of the transaction is either cash account or bank account. A third method is what we call a credit transaction. In a credit transaction, the payment for the purchase is deferred or postponed. Let us say I as a business, while purchasing goods, have been given a 30-day credit. That is, the supplier of the material gives me a grace period, a time period of 30 days to pay for it. So if the consignment of material is purchased today, 11th of April 2020, I need to make the payment by 10th of May 2020. At any time during this period of 1 month, I will make the payment. So when the transaction is a credit transaction, that is a sale to me or a purchase by me on credit, where the payment is deferred or postponed. So there are two types of purchases. One is a payment basis, the other is a credit basis. In either case, one of the accounts is purchases. Purchases account as one leg is identified. The corresponding double entry, the second of the double entry, the second leg is, in this case, cash account. In this case, bank account. What if it is a credit transaction? What happens to the second leg? The second leg of the transaction is what we call the creditor's account. Since there could be many suppliers of raw material, each of which I as a businessman have to keep track of, I might call them sundry creditors. So two methods of arranging a purchase: paid for immediately or paid for promise to be paid subsequently on deferred basis. In either case, one leg of the transaction is either cash or bank, depending on the method of settlement or payment. Where it is purchased on a credit basis, promised to be paid in future, the second leg of the transaction is sundry creditors. So purchase account, sundry creditors account. Within the period of 1 month to ensue, when I make the payment, that is another business transaction, where one leg is sundry creditors and the other leg cash or bank. Now extend the same principle to a sale. I, as a businessman, I have purchased raw materials, I have converted them into finished goods, I have sold them. When I sell them as finished products, the sale may be on payment basis or credit basis. In the payment basis, I immediately receive cash or I receive a banking instrument, a check or an electronic system of receipt this time. Whereas if the sale is on credit, one leg of my transaction is sales, the sales account, and the other leg of the transaction is sundry debtors. A creditor is a person to whom I have to make a payment. A debtor is a person from whom I have to receive payment in respect of goods sold. So let us say at the end of the accounting cycle or the accounting period, the money measurement period, there are some creditors whom I have to pay. They will appear as a liability of the business. There are some debtors from whom I am yet to receive payment. They will appear as the asset of the business. So that is the difference between a cash or a payment transaction and a credit transaction. In a credit transaction, there is a liability to pay or a right to receive. In the case of sundry creditors, it is a liability to pay. And in the case of sundry debtors, it is a right to receive an amount due in respect of sales made. So a sale transaction or a purchase transaction, whether it is inventory, goods, or assets, or investments. For example, instead of depositing some amount, a surplus which I have created out of business with a bank or in a bank account, I can invest the same in, let us say, shares of a company, in the capital of a partnership firm, in a life insurance policy, in a medical policy, in gold. They are investments. So we technically use the word investment instead of an expenditure. So whether it is purchase of inventory or sale of inventory, purchase of assets, sale of assets, purchase of investments, sale or settlement of investments, closure of investments, it could be on a cash basis or a credit basis. Credit is deferred. Cash is immediate. Cash or bank. So, brushing up, business transactions shall be measurable in money. The two legs of the transaction have to be identified to satisfy double entry bookkeeping. 3. The transaction could be a cash transaction or a credit transaction where the payment or receipt is deferred. So any purchase or sale transaction will have this kind of a cash credit classification. Similarly, at the end of a month, let us say, or a quarter, let us say, or a half year, let us say, there is expenditure which has become due to be paid, whereas the payment is effected only in the next accounting period. Take the example of salary to workers. I am a business, let us say I have incorporated as a company or the corporate business form. As a company, I have 75 employees or workers. These employees or workers are working on a continuous basis, whereas the payment made to them is on a monthly basis. So the workers or employees work for the month of April, and for the month of April they get paid on April 5th or April 7th, the first week, the end of the first week of the next month. Whereas these wages or salaries which are to be paid have fallen due on the last day of the month. So April is a month which begins with the 1st and ends with the 30th. The work carried out by the workers is on a consistent basis throughout the month up to the 30th, commencing on the 1st. On the 30th of April in the evening at about 5 p.m., 5:30 p.m., my liability to pay the wages or salary is ascertained, whereas I make the payment only by, let us say, the 5th of May, 5-6 days later. So when I'm setting right my bookkeeping or accounting records for the month of April, on April 30th when I closed the books of account, when I'm recording the transactions of the month of April, I need to account for these wages, remembering or recognizing that I am not paying for them on the 30th, another form of a credit transaction. So these wages or salaries have become payable. Just like when I make a credit purchase of goods, the amount to the creditors is payable. Or when I make a sale of inventory on a credit basis, the amount is receivable. The payable wages or salaries are to be accounted for on the 30th of April. One leg of the transaction is the wages account or the salary account. This is one leg of the transaction. The other leg of the transaction is wages or salaries payable account, also called wages or salary outstanding account. So one of them has to be debited, the other has to be credited. So instead of sundry creditors or sundry debtors, here we create that expenditure outstanding accounts. By passing this entry, by passing this accounting transaction record, I complete the transactions of April fully and completely. I cannot wait for May 5th and pass this entry, because this particular aspect is applicable to April. It will affect my profitability of April or my financial position of April. So the transaction has to be recorded in April before it closes. So as a closing entry for the month of April, I will record this. Wages or salary as one leg, and wages or salary payable or wages or salary outstanding as the other leg. So business transactions are settled either in cash or recognizing the liability or the right to receive or pay in the future. So in these types of business transactions, the second leg affected is neither cash nor bank. We have created or opened a sundry debtors account, a sundry creditors account, an expenditure outstanding account. Or had this been an income, it should have been an income receivable account. Also called income accrued account. Accrued means or only means generated or accumulated. So here there's a duty to pay, there's a liability to pay. Here there's a right to receive. For example, as a businessman, one of the machines that I'm not using in my business, I rent it to another. By renting it, I get an income in the form of rent on this machine. On the same principle, the rent accrues on a daily basis between April 1st and April 30th. So on April 30th, there is established a right to receive that rent, although it would be received only on, let us say, 5th of May or 6th of May or 7th of May. But in order to ensure that my transactions are complete for the month of April, I will account this nevertheless, taking one leg of the transaction as rent and the other as rent accrued or rent receivable, the two legs of the transaction. So every transaction, whether incurred in cash or by way of a deferred payment credit basis, the two legs have to be identified. Now, if I word a transaction, purchased goods from Messrs. Sunridges and Company for rupees 30,000, it means that Sunridges and Company is a creditor. The cash is not being paid. Suppose the transaction is worded as purchased from Sunridges and Company on cash rupees 30,000 worth of goods. Then Sunridges and Company is not relevant because the payment has been made in cash. So if the payment is made in cash for a purchase, the name of the creditor. Similarly, on a receipt, the name of the debtor is not relevant. Cash is definitely the other leg, or bank is the other leg of the transaction. So it is only in a credit or an accrual, outstanding, receivable, payable transaction that the sundry creditors, sundry debtors, outstanding account or accrued account becomes relevant. And why is that done? To complete the accounting for the accounting period.